Another day, another video. Now I'm very excited about this video because we're talking about Fundrise, and you guys know that I'm always hunting for new investments out there that can basically make me more money and basically make you more money. But before I actually recommend anything to you guys, I always have to do my research and everything like that. And for this one, it's basically real estate. Now real estate is something that takes a lot of money to actually get into, and Fundrise allows you the opportunity, I guess, to kind of like invest money like maybe $500 to $1,000. And yes, that's actually what it takes to actually start investing into Fundrise. You need at least $500 or $1,000 to get into one of their plans. I'm going to talk about the plans later on, right? But you need some money to actually get in, and you can actually start investing into real estate without having to put down a down payment on a house that costs like literally like $600,000 in the New York area or anything like that. So it's not really that much money compared to actually buying physical real estate, and it actually makes you a ton of money. So I want to make sure I talk to you guys today about what Fundrise is. Is it a scam? Is it a good investment? Is it a bad investment? And what I actually found out, because when I first read every single thing that I read about like Fundrise, I actually wanted to start investing every single month into Fundrise until I did more research, and we're actually going to talk about that right now. So the first thing I want to talk about is the returns. Right now, in the thumbnail of my video, you even noticed that they beat out the SP 500s last year because they got like around a 13% return, and the SP 500 only got around like a 7%, right? And here's my main thing when it comes to this return thing and this return factor. I feel as if what they're doing is like a tactic, and I'm not trying to like down anybody or anything like that, because the returns are real, obviously, and the money is real, obviously, right? But the returns can't really be formulated if it's just because the real estate market is booming right now, or is it just because they are doing everything correctly? Because, for example, if I put money into the stock market and the stock market is going up, it's just going up, you know, like it has nothing to do with me. But for them, they're doing individual investments into real estate properties, buying buildings, buying hotels, buying every single type of thing out there. And I actually did research on what they actually buy, and by what they actually buy and what they're actually doing, buying in local areas, buying in areas that are coming up, buying before the trend actually starts, they're actually making very good investments, and that's why their returns are so high. So a 13% return means this, right, guys? But you guys know I like to do the math as always, right? So for example, if you had put $1,000 in their company last year into entire Fundrise thing, right, you would have made around times 1.13. You would have made $130 return, which sounds very good. And by the way, guys, you guys are probably telling me, Tommy, I get it, right? You're putting money into this investments and you're making money back, right? And that sounds great, but how does it actually work? Because I personally invest into like VNQ, which is a Vanguard ETF, which is an investment fund. But the way I actually do it is I invest in there, and that's fine. But with Fundrise, it's a little bit more different because it's something brand new, and it's called like a reits. So it's an electric form of like real estate, basically, right? And it sounds very good, and it sounds very prominent, and it sounds very new. But what it basically means is this. I'm going to tell you guys a little story, right? I don't know if you guys know this, right? But in England, I think it was England or Paris, they actually made an entire bank, right? And they would sell people notes of debt, right? And it was like, that was the entire thing. Like, they would sell them notes of debt, and people would get like high interest rates on them, and they would make a lot of money off them. And while everything was going very well, people would trade them and stuff like that, right? But it was brand new, so you couldn't really trade it into like a stock exchange or anything like that. Because if I want to sell my investments in the stock market, I can just literally go right now and sell it, right? Sounds good, right? But with this company, since this is a new thing, they're treating it inside of their entire company. So if you're buying something, if you're buying like stocks or shares or whatever you're buying with this company, you can't just trade it, just put it in the market and somebody buys your order. It doesn't really work like that. And that's the main thing I do want to get across. And if you're wondering about liquidity, which means like how can you actually get your money out, I'm going to talk about that a little bit later in the video. So now that I told you about the profits and the returns and everything like that, and by the way, this company makes like around a 7% dividend payment to their like shareholders every single year, which is very good. But before I even get to that part, I really want to talk about the expenses of this company, right? So for example, they say that they only charge you around a 1% fee, but if you go into this fine print, they actually tell you that they can actually raise that on a yearly basis depending on what properties they bought or what properties they're actually selling. And that's not really that good because, for example, they can bump it up to like 3% instead of 1%. And what does this mean, Tommy? 3% isn't really that much, because if I'm getting paid 13% returns on average, which on average like right now because the market is booming, but remember, the market goes like this, and it goes like this, and it goes like this, and it goes like this. It's a pattern. It's been going on for hundreds of years. It's not going to change just because it's going well right now. It's going to go down someday, right? So they're charging you around 3%, right? So that makes your entire like profit really being like maybe like 13% minus 3%, that's 10%. Still very good, right? You're still probably saying that's very good. But for example, what if I told you that you actually invested in VNQ, which is a Vanguard investment fund, you're actually only paying around 0.26% for the expense ratio. So what does this mean, Tommy? It means that I lost my phone. That's what it means. It means that, look at this, right? It means this. If you take 0.26 and you divide it by 3, okay, if you take 3 and you divide it by 0.26, it shows you 11, right? It means that the Fundrise expenses are actually 11 times more expensive than what Vanguard actually charges you. And what does this mean, Tommy? It means that your profits are actually being cut. And if you're wondering, well, Tommy, it's not the same, because if you invest in Vanguard, you're actually not getting that much money back. So either way, after you take out the expenses and stuff like that, you're still making much more money. Well, in reality, no. Because let's do some quick math also, right? If you had put in Vanguard, in the VNQ fund, if you had put $10,000 10 years ago, that money would be equivalent to now being around $50,000, right? It means that you didn't double your money, or triple your money, or quadruple your money. It means that you made 5 times your money in less than 10 years. And by the way, if you know anything about like business or anything like that, you know that the average investment takes around 10 years to actually double. So this is actually crazy. So in reality, when you're asking me about this entire thing, right? Well, you're making a lot of money, but in reality, it's all going to expenses. So I really don't like that entire part about it. But let's talk about the pros of the company, right? Because there's a lot of things that are actually good with the company that I actually want to discuss, right? For example, so you're locked into this investments, you have high returns, and they're actually good investments. Tommy, what do you mean by all of this? It means that you're locked in. When I say you're locked in, I mean that you're locked in, right? For example, if I invest in Vanguard, right? $100,000, $1 million, it doesn't really matter. If I change my mind or I find a better investment down the road or anything like that, I can actually just pull my money the next day by trading what I actually bought, right? That's fine, that's perfect. Perfect and dandy, right? But if I actually invest $1 million or $100,000 or even $1,000 or $10,000, it doesn't matter what amount it is, right? If I invest into Fundrise and the next day I'm like, oh my gosh, I changed my mind, I don't want to do this, I found actually a better investment out there, they're not actually going to let you take the money out. Well, what they actually say is this, right? You're locked in for 5 years, right? But if you want to take your money out before that time, they can actually analyze it and see if you can actually take you out. But if it's not what's actually best for all the shareholders, then they're going to leave you locked in. And I think that if you actually want to take your money out and you're actually forcing it, then they're going to actually penalize you by like around a 3% fee. I think that's how it works. But in reality, you're actually locked in. And Tommy, what do you mean this is a pro, right? Because I said it is a pro. I mean it's a pro because imagine this, right? If they're actually making good investments, because I said they're actually making good investments, and they're very good at making investments into real estate because they're buying like real estate in prominent areas, and they have a lot of capital to actually negotiate good deals. So this is actually very good, right? If the market goes down, well, not if, when the market goes down, there will be a lot of people in panic. And what does this mean, Tommy? When people are in panic, they tend to sell their shares. They tend to lose out on the entire gains that come after you make a big loss like that. For example, like in 2008, right? If you had just held your money for a little bit longer, you actually would have been making money now, right? But with Fundrise, even if the market is down, they can decide if they can either liquidate you or they cannot liquidate you. So you don't really have the freedom of liquidating your stocks, either because you're having a bad time or anything like that. They can actually decide for you. And that's not really that good for me because I'm an entrepreneur. So for example, I don't want to put my money anywhere that actually locks me in, because what happens if I invest $100,000 into this company and then the next day I actually find like a duplex or anything like that that's actually going for less money? And I don't want to do that. I don't want to be locked in. And some of the cons of this entire thing, by the way, I have a book now, I have a notebook. Now, some of the cons are exactly what the pros are. For example, I don't like being locked in. Second, it's a new company, so you really never know what's actually going to happen. And by the way, the VNQ and the stock market and Vanguard, these are companies that have been around for over 100 years. So they have 100 years of history. While this company has been around for maybe like 5 years, maybe 6 years max. And all they can say is like, oh my gosh, we beat the market last year by 13%, whatever, blah, blah, blah. But in reality, what can you actually say for the next 100 years or the next 50 years? Because people that are investing into these things in real estate, they're going to be investing for their entire lifetime. And the entire like mantra or thing that they say is, real estate is long-term investment and it's not meant to be liquidable. That's why we hold your money for at least 5 years, because we can't just sell it whenever you want to sell it. And that's what I really don't like, because I feel as if, for example, right, this is just an idea and I'm kind of going off script here. If they have over $150 million, right? By the way, they have over $1 billion in like assets and stuff like that, right? But Tommy, what are you talking about? Well, I'm talking about if they have 300,000 users, right? Which is say they have on their website, and these users paying like around maybe $500, maybe $1,000, right? Let's do 1,000. Let's do high end. I always do low end. I want to do high end this time, right? We times it by $1,000, and we got $300 million, right? Why don't you take a percentage of that money, maybe like maybe 25%, maybe 10%, and just have it there to actually have people liquidate their entire funds. So whenever I want to liquidate myself, you can just take money from that like little chunk, and just take it out and liquidate people and have that freedom, because having freedom it's probably gonna allow you to have more customers. Now guys, another thing is that I just haven't done research on looking at their fine print or looking over their website and all these things. I've actually watched several YouTube videos on people actually talking about these things, right? And I even looked up this guy. By the way, I'm not gonna name any names, but if you looked up Fundrise on YouTube, it's gonna be like literally the second video, and it's a guy talking about like he invested $1,000 into Fundrise, and now he has $1,048, and youppie, I'm making so much money. But in reality, here's the thing, right? This guy is kind of biased, and I want you guys to make sure when you're doing more research on things, don't look for people that have literally like a referral link in their bio and they're saying like, oh my gosh, this product is so good, bro, it doesn't matter, you know what I'm saying? Like, no, don't look for those people. Look for people that don't have referral links, because they're not biased. And by the way, I have a referral link for Acorn. That means that I'm a little bit biased because I like Acorn and I like investing into it, and I also get $5 every time you guys sign up for it. So that's fine, and I'm also giving you guys the details on it, but don't just look at me, look at other people, and actually look to actually research everything. And one last thing I do want to say before I end this video right now is that the reason I can't invest into Fundrise is because it's too expensive, bro. You're charging me way too much money to actually help me invest. It's like 3%. It's 11 times higher than what Vanguard charging me. Second, I don't like having my money locked in. Like, you're locking in my money for 5 years. What happens if something happens or anything like that? It's not actually good. And anyone out there that's telling me, Tommy, you're not a good investor because you're supposed to have money locked in, bro, you never really know what's going to happen, and you never really know what opportunity is actually going to come up. Like, for example, if I had locked in my money into certain investments, then I probably wouldn't be able to make as much money as I do now, because I had the chance to actually come up with opportunities that are like right then and there, like invest the money and make a high return. So you never really know what opportunities you're going to be missing on by locking in your money. That's why I don't recommend it. Guys, my name is TommyBryson. If you don't know me and you actually enjoyed anything that I had to say in this video, go ahead and subscribe and like and comment and let me know what you think about Fundrise. If you're actually going to be investing, I personally won't. I don't recommend it. Literally just go into Vanguard, invest into VNQ or one of the other funds, and literally just pay like $86 per share. And guess what? You have the freedom that if you change your mind, you can literally sell it the next day. It doesn't really matter, but I don't recommend that. I only recommend you actually sell your investments when you have a better investment lined up. I don't recommend you sell your investments because you have this huge emergency or anything like that, because I personally have an emergency fund just in case any emergencies happens. But when it comes to liquidating my investments, I only do that under one strict rule, which is I have a better investment, so I'm going to invest into that investment. I'm not going to be locked into anything. Guys, I'll see you guys next time on the next video, and peace. You've got to start